Hello, this is Eric Boyce, President and CEO, Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for March 5th of 2023. Here, disclaimer for important information. In the chart pack this morning, I thought I'd start with an educational piece, and this gives us 7-year annual rolling returns for stocks, bonds, and a combined what we call a growth portfolio, kind of defined as 60% stocks and 40% bonds. And so coming off the year that we had, I saw this chart from Charlie Bolello and thought it was really illustrative of why you diversify and why you focus on longer term horizons. And so obviously the markets bounce around, we know that. This time series goes back to 1983. So it's a long period of time. It's basically 40 years of data here, and you can see markets do bounce around, as I said. But if you look at it as of the end of last month, so the rolling 7-year return for a 60-40 portfolio, a growth portfolio, mind you, is about 6%. So stocks have returned about 9.4% during that period. And bonds just above the break-even line, about 0.4%, 40 basis points there. You can see the impact of the rolling returns if you look at the beginning of this decade when we had poor markets right at the end of 1999 into 2002. You can see the impact there, and then also the impact of the global financial crisis that depressed those rolling returns for quite a number of years. In fact, when you look at the years between, both the tech bubble bursting and the aftermath of the global financial crisis, that was kind of like a lost decade in terms of returns. But then, even with that, you can see, that over time, time cures a lot of evils here. And so over time, you see that number really kind of gravitating in that range. And long-term stock returns, going back to 1926 or about 8, 9, 10%. 10% if you include dividend reinvestment, and then bonds are maybe a little bit more than half of that, but with about a quarter of the volatility. But anyway, this chart I thought did a really good job of showing how diversification helps you over the long run, and it mutes that volatility that you see in equities, and as we certainly saw last year, in fixed income as well. Here's a quick chart with bars showing you the various maturities along the yield curve. And so I thought this was very interesting in the sense that this is the first time that we've seen since 2007 the entire maturity spectrum on the yield curve above 4%. And, we've seen at various times, parts of this curve well above 4. We know that the yield curve is inverted. You can see that because shorter dated maturities are yielding more than longer dated maturities are. We'll see in a second. There might be some upward bias here in the longer dated yields, but you can see here everything is above 4%. We just haven't seen that in a long time. A couple of charts on the Fed funds rate. And so on the left-hand side from Alpine Micro, we've got the real Fed funds rate, which is a nominal rate adjusted for inflation. We can see that that's above 2% right now, which by this definition is actually fairly restrictive. You can see the shaded bars overlaid here. Those represent recession periods. And so, what we're seeing now is not inconsistent with what you would see in a recession period, but you can see we've come a long way in a relatively short period of time in terms of not only moving away from negative real Fed funds to a positive rate, and the magnitude of that change and the pace at which we've seen that is also very, very restrictive. And so on the right-hand side, what we look at here is also the Fed funds rate in the kind of the gray shaded solid line, and then that is overlaid with money supply growth. On a year-over-year basis, we know that money supply, as we've talked about many times over the last several months, has actually been very negative over the last year. And you can see that where we are now in terms of money supply growth is about negative 5% year over year. So the punch bowl is being taken away. And so what that does is make that money that's out there in circulation in these various definitions of money supply, whether M1 or M2, makes it more scarce. And so that would tend to drive the Fed funds rate higher, which we already feel pretty comfortable with the notion that the Federal Reserve is going to continue to want to fight inflation. So they're going to move that Fed funds rate higher. In fact, a little bit more as of late, given the latest set of readings, than we thought even like 2 or 3 months ago. And so continuing with the theme of short-term interest rates, we see here a chart from Charlie Bolello on our 3-month Treasury yield, which is about 4.9%. And I told you that, the entire curve now is above 4%, but in particular, the short end of the curve is really spiking in response to this expectation of Fed rate increases. And we've got a chart on the next slide that talks about where the market kind of thinks that trajectory is. But as we can see here, 4.91, the highest 3-month yield that we've seen on Treasury since 2007. And here is that market expectation. You can see here that that's changed a little bit. As we get into late summer, the expectation is that we're going to peak out about 5.4, maybe 5.5%. That is a relative increase from just 2 months ago when there was a groundswell of opinion that maybe 5.1, 5.2 was going to be the peak. And so, basically the market is pricing in another 25 basis points or 1/4% rate increase before the Fed kind of takes a pause in the July-August timeframe. And, the expectation here is that rates are going to begin to come down as we see maybe economic softness and the Fed responds to that. Now, the Fed's own expectation is not for rates to come down, but rather for them to pause. And this is actually a disconnect right now between what the market expects and what the Fed is kind of telling us right now. And we're going to have to reconcile those two. But right now, it's a saying essentially by call it the end of December 2024, the end of next year, that we're going to have rates that are going to be dropping almost 1.5%. So, we'll just have to wait and see. That's very speculative at this point, but at least this is a synopsis of what the market believes. Well, here's a couple of charts on term premium, and this is why I think there might be some upward bias in the kind of the medium term maturities, like somewhere in that 7 to 12 year range. And what you see here at the upper end of this chart here, this is the volatility in inflation on a 2-year basis. And it's a year-over-year number. That's in the black line. You can see that volatility has been extremely high. And then you've got the term premium that's calculated in that more of that kind of brownish line there. And so that term premium is at a real disconnect right now to where the volatility levels are on inflation. And so the expectation is that term premium is going to go up. And so when you add term premium to a 10-year Treasury, that implies that your 10-year Treasury yield is going to go up, and that at some point you will no longer have an inverted yield curve, but you'll have a normal looking curve with higher overall rates than we've seen over the last decade. And and on the bottom, you see that term premium also in the, that term premium is in the black line, and then University of Michigan inflation expectations looking out 5 to 10 years, you can see that inflation expectations move higher. And that's yet another indicator that would tend to suggest that your term premium is going to move higher. So again, this analysis tells us or suggests to us that those 10-year yields are going to move higher based on the data that we're seeing today. Here's another chart from Charlie Bolello that I thought was really interesting. So it looks at the U.S. aggregate bond index and the longest drawdowns. I mean, we're actually still negative in the bond market this year. Stocks had a really good month in January, a somewhat weak and tepid month in February, but bonds have been negative thus far. And so when we look at the duration of this downdraft in fixed income returns, I mean, we're down or max drawdown on a monthly basis is 17%. And so we've been negative in bonds since August of 2020, if you can imagine that. Now, if you go back to 1976, this is the largest max drawdown that we've seen, fairly pronounced. I mean, well above even 1979 to 1980 when we were running at massive levels of inflation at that point. And so you can see that, we're in rarefied air. We're at 31 months in current duration on this drawdown, and that is well above the average. So a quick S&P 500 chart, a little bit of noise here. We have moving averages. So obviously the black candlestick bars there represent the daily prices and the intraday moves for the S&P 500. You can see here going back to August of last year, the various movements and the gyrations in the stock market. And so that's overlaid with these various moving averages. And what's really interesting is that we're coming to a juncture on all of these moving averages right now. It's a very interesting technical occurrence. So you see in the kind of that blue purple line here, that's the 50-day moving average. So again, a shorter moving average is going to oscillate a little bit more. And then the green line represents a 100-day moving average, which again, think about longer durations, begins to smooth itself out. And then the red line represents the 200-day moving average. And you can see from a technical standpoint that we have really hit this inflection point. And so, again, I'm not going to wax poetic here on whether I think that this is a bullish pattern, but it doesn't happen very often. But we're at a point now where, we've retested that 200-day moving average. We bounced off of that. And we're kind of fighting with that 50-day moving average, but the 50-day has moved above the 200-day average. And when you get that kind of action in the market, you tend to have upside potential in the market. So, all economic data notwithstanding, from a technical point of view, the market actually looks somewhat decent here. Well, and every leaf has an opposite side to it, and so if we look at the individual investors, and this is the AAII investor sentiment reading, and so this is actually the bearish side of that reading. So they ask questions: Are you bullish? Are you bearish? And what's your net position? So this happens to be the bearish sentiment, and you can see as you scroll all the way through these noisy data points to the far right, where that number stands. Now, obviously, it's not as bearish as we saw it at many points last year when we had a lot of volatility, but it certainly has spiked off this low. I mean, if you go back to say December, January, that number is actually pretty bullish, but we've somewhat reversed course here. And both on an aggregate reading as well as kind of like the rate of change reading that we see here. So we're going to transition into the stock market and kind of talk about a few different things here. So this is actually the analyst estimate for this year's S&P 500, and think about think about this as kind of like a sum of all of the earnings of every company in the index, and kind of like totaled up. And so, when we were looking at this, last year, we thought that, the S&P 500 was going to generate about $250 of income, or excuse me, of earnings for the index. And then now that number has come down really about 10 to 12% here, and now we're down to around $223 for the index. And so this has implications in a lot of different areas. So obviously, the first and foremost, it's valuation. When you think about price to earnings, so if you have price levels or index levels that are constant, but your earnings are going down, your price to earnings multiple actually goes up. And so this has been the big worry of the market about whether earnings were going to crater and it was going to put downward pressure on the market. Well, we know that earnings are coming down. We know that margins are coming down. That is absolutely no secret. And so we see this very clearly here that these estimates have become a little bit more conservative over time. So looking at earnings through a different lens here, we've got two different measurements for earnings. And there's the kind of like the standard accounting approach, which utilizes generally accepted accounting practices or GAAP. You can see that in the gray line. You can see that that number is reversed, and it's actually one of the strongest reversals that we've seen in quite some time. In fact, obviously the pandemic, we saw that during the shutdown, but also if you go back to the last two recessions, that is about the last time that we've seen an earnings reversal of that magnitude on purely a GAAP basis. And then you have this other thing called adjusted earnings, and so that is where you're adjusting out a lot of things, options expense, and a lot of non-recurring items to get to kind of what they call a more normalized earnings per share number. And that you see here is still going up about $222 versus $187. But I think the thing that we should focus on is that GAAP number, that accounting earnings number, is definitely going down. And here's that follow-up chart to the last one we just spoke about. And this is the S&P 500 year-over-year change in earnings as reported on a GAAP basis, or as I said, generally accepted accounting principles. This is kind of akin to what I'd say like an all-in number, so to speak. And that number is down 28%. Obviously, margins have had an impact. Sales growth has had an impact. Increased interest burden has had an impact, and so there's a lot of things that affect that number. And but 28% downdraft in earnings growth year over year is a pretty stark development here. And obviously, you go back to the pandemic, you had a big drawdown there. We just talked about that, and then you got to go all the way back to the global financial crisis to witness a drawdown in GAAP earnings like the likes of which that we're seeing right now. So, like I said, the calculation of earnings is important, and the pace and the trend of earnings growth is important in terms of how we look at the price to earnings ratio, and that is essentially what is the valuation in the market. And we know when interest rates are high, when inflation is high and the interest rates are moving higher to combat inflation, that typically compresses price to earnings multiples in the market. And we can see that has clearly been the case here as of late. But if we look at where the market is now based on these earnings revisions in the market, and this is a forward 12-month PE ratio. So as you saw a few slides ago, where we saw that the earnings estimate for the S&P 500 index has gone down about 10% or so, that is reflected in this number. And so where we are right now in the market, we're priced about 17.5 times forward earnings. And you've got two dotted lines here. The green dotted line is a 5-year average forward 12-month PE. So we're actually below that, but multiples have been higher over the last 5 years, around 18.5%. So we're below that, which is good. However, we are above that other blue dotted line there, which is a 10-year forward PE, which is about 17.2 times. So we're not too far away from that, but I'm not saying, I guess the takeaway here is that we're certainly not like terribly expensive, but we're not cheap either. And there are a lot of folks out there that want to draw attention to the fact that if there's a significant further erosion in earnings, that this price to earnings ratio is going to be out of whack a little bit and is probably apt to move higher. And I guess the real question is what's going to happen to earnings? Are we going to have this soft landing or what? Well, we'll talk about the equity market in a slightly different sense. This is growth versus value, and you can see that that this relationship bounces around a lot. If you go back a long period of time, you've got quantitative firms like dimensional funds that have done all these calculations, and it turns out that over a long period of time, that value tends to outperform growth. And but at various junctures, that's clearly not the case. And at some points, you get these massive dislocations like we had last year. In fact, you look at that gap between 2021 and 2023, where we are thus far this year. I mean, growth underperformed value by 22 percentage points. I mean, that you have to go back, honestly, to the year 2000 to see a larger gap between those two. And so far this year, growth has outperformed value by about 6 percentage points, but I've got a feeling that number is going to bounce around a little bit. And if you think you're on the eve of recession, value tends to outperform growth during a recession. So this number could turn around quite a bit. And when we get to the end of the year, this relationship may look completely different than it does right now. Here's a chart that depicts retail investor activity. In particular, on the left-hand side, it's a retail investor's interest in single stocks. So this would be like, somebody literally going to Robinhood or Schwab or someplace and buying an individual stock. Now, we know that there's been a lot of interest in Tesla lately, and Tesla's actually had a lot to do with this, but you see that amber line really spike up. We've had a dramatic increase in individual stock purchases by retail investors. And I think that has had something to do with kind of like how we have started on a net basis, how we've started the year in the equity market being up, even though February was somewhat weak. But as you transition over to, and before we leave that, you can see ETFs in that dotted blue line there on the left-hand chart. That's also trending up. So you have more retail interest in stocks, period, and in particular, individual stocks. But if you go to the right-hand side, you see here that you've got the S&P 500, obviously trailing off, but still positive net for the year. And where the retail investment stands right now, I think a case could be made that that's going to roll over at some point. And even if you go back and look at the left, that you find that these like dislocations never last really long. And we're at a really dislocated point right now where this individual interest, stock interest is super high relative to ETFs and relative to where the market is. And I just think that there's apt to be some mean reversion, and that's exactly what this chart on the right hand is suggesting, that we have kind of a downturn, if you will, in retail investor activity. Now we'll talk about the housing sector and a few charts that I thought were really interesting. This one goes back to 1891. There's a hell of a lot of data here. And the middle column represents the nominal change in national home prices. Again, just the kind of the raw change. And as you can see clearly that there are more years where it's gone up versus gone down. Obviously, if you go to Great Depression or recessionary periods, that number is negative. And you got to go back to the global financial crisis, and we know what happened then. That was a multi-year period of house price declines that led to the creation of a fantastic new market in housing, which, as you can see over the last decade, has produced very solid gains. But outside of the global financial crisis, you've got to go all the way back to 1990, which was a recession year, to see any kind of a negative change in nominal home prices. But when you get into higher inflationary periods, like we were and have been in over the last 12 to 18 months, you can see that the real home price change last year on a national base per the S&P Case-Shiller index is down 1%. And so, not too odd to have those, but they're usually not associated with non-recessionary periods. And even if you go back to the early to mid 90s, you just had higher overall inflation, and you had fairly tepid growth in home prices, and that's why those real changes during much of the early to mid 90s were negative, kind of flat to negative. But just wanted to show this for illustrative purposes, that that certainly over the last two generations of home buyers, that number has a really strong bias up. But when you have a stretch of home price gains that have clearly outpaced inflation. I mean, clearly outpaced inflation. At some point, you have some reckoning. And here's a chart from Redfin on home buyer mortgage payments that, as we know, have gone up because of the rise in interest rates and the rise in mortgage rates. And we know the burden on households is much greater than it used to be. And this data goes back to 2020. You can see when rates were a lot lower, that the mortgage payment back then on a basically on a median asking price, it was significantly lower than it is now. And in every case we saw these numbers move higher. Even throughout the year 2020, throughout the year 2021, and particularly last year, it went up, and we see that burden continues to move higher. So we're moving back up. Our average 30-year conforming mortgage rate is about 6.6 now. It was 7.2 and then came off the peak. We had a lot of volatility. We've got some charts on that, but clearly mortgage burdens on households is higher than it has been. And here's a quick look at those mortgage rates. This is the 30-year survey nationally, about 6.6, 6.7%. You can see that's come off the low. This is a long data series that goes back to the beginning of this current 21st century. But clearly, if you look at 2020, where that low point was, we've moved considerably higher, and then came off the peak, and then now we're moving back up again. Looking at inflation here, a chart that caught my eye was, this whole issue of demand-driven inflation versus supply-driven inflation. And, the demand factor had really been in play for some time. We were demanding goods, and shipping rates were high, and things were in short supply, and so we were paying more. And then supply-based inflation really took hold. And so, if you look at this chart from Bank of America, you can see that, supply-driven inflation is kind of off its peak, but oddly enough, demand is still very high, and that's had an impact on helping to keep inflation from dropping faster than I think folks would have ordinarily expected. Quick look at the Federal Reserve balance sheet, and we know that this is the other side of what's going on to raising interest rates. So that's receives all the headlines out there as the Fed is raising rates and increasing the cost of capital, cost of borrowing, cost of debt. In fact, really the cost of everything in the market. Well, this is the other side of that coin, where they are allowing their balance sheet to shrink by letting securities that are maturing run off and not repurchase those securities. And so the Fed, its balance sheet, you can see here at its peak, was just under $9 trillion, and now it's about 8.34 trillion, and that hundredths digit is actually pretty important when you're talking about $8-9 trillion. But it's down about 620 billion from April 22. And you'll continue to see that, and this is helping to create a negative year-over-year growth in the money supply, and this will help to bring down inflation over time. Here's unit labor costs, and we got that data recently, and this is something that has long been discussed as being a contributor to sticky inflation, if you will, labor. Once you increase your labor costs, it's hard for them to come down unless you have a major economic event. And so, right now, that year-over-year change on a seasonally adjusted basis is about 6.3%. So good news is that we're off the peak. However, the bad news is that it is still in the aggregate very high. And you've got to go back to basically the late 70s to early 80s to see kind of wage inflation that we're witnessing right now. Just a quick look at retail sales, and something we've talked about a few times here over the last several weeks is this shifting in consumer spending patterns. And you can see grocery stores witnessing continued uptick. And this And then in the meantime, you see like, electronics and appliance stores, that's trending down. Department stores, even with this recent leg up, has been kind of like flatlining. And so what you see here is that, consumers by and large in their retail consumption is much more recently favoring essential items like grocery items and drugs and food and that those types of things over these more discretionary things at a time where prices are high. Here's looking at e-commerce retail sales, and this is on a real basis too. So, this is a kind of a subcomponent. Just think about, the world we live in now. Everyone's buying stuff off of Amazon and utilizing e-commerce. And so, these numbers, 20 years ago were far less important than they are today because, everyone has broadband and whatnot. And so, utilization of e-commerce has continue to move higher every single year. So this number is pretty important. And when you see the number kind of around the flat line, on a quarterly basis, here's a year-over-year change is actually negative in real retail sales. That tells you something. That tells you that consumption is slowing down, which again, if you're the Federal Reserve, that's a good thing. That's what you're trying to generate. If you're looking at it through a purely economic lens at a 50,000 foot level, that's not so good because that means your overall consumption is slowing. And here's some other charts that I thought were really interesting. BCA does such an awesome job with research. I wish I could spend more time with their work, but on the left-hand side, something that, I think when we talk about consumption, we talk about retail sales and all this stuff, it's really important to note that, when you look at the areas, the areas of the economy, the cohorts of the economy that are being impacted the most here, don't represent the bulk of the spending. When you think about, higher gas prices, higher food costs, those tend to impact the lower income folks a lot more than the higher income. It makes sense, right? And so, but you see the lowest quintile, the lowest 20% of the income earners in this country account for only 9% of the consumption. And you can see where that goes up. So, basically the bottom 60% here account for just under 40% of the of total spending, and you've got the top two income earning brackets that account for the lion's share. And so when you think about how higher interest rates are impacting spending, well, obviously if you're a high income earner, and you've got inflation moving higher, you're less sensitive to this, but you're controlling a lot more of the spending. And I think this is a reason why that despite these interest rate increases, which you would think would curb spending, and it is curbing spending. We just saw that in online sales. It's not doing it nearly as fast because most of the consumption comes from these high income earners. So that's the left-hand side. The right-hand side is, a chart that also helps to remind us that the consumers still have a lot of firepower, regardless of what income bracket you're looking at. But you can see in this chart that household checking deposits as a percent of personal disposable income is still really, really high. And so there's a lot of firepower here to that will help this economy be much more resilient in the face of all these measures which are trying to slow it down. Here's median housing payment as a percent of median income. I think we saw this in a different way a few charts ago, and we're talking about mortgage payments moving higher consistently over the last several years. And you can see here that the number is pretty stout. I mean, this is data from the Atlanta Fed, which does a really good job of tracking all this. But even though we're off the peak, 42.9% housing payment as a percent of income is higher than what we even saw back in the global financial crisis, which had a huge housing dislocation. So this is something we want to watch. Obviously, mortgage payments as a burden on total income has gone up. And so this is something that clearly is going to stall the housing market to some degree, and I think in many respects will help us normalize it. Here's PCE, personal consumption expenditures, versus the CPI. And we've talked about the difference between these two at times. And the PCE tends to fall below the CPI, although there have been times where we've been on top of each other, maybe even like inflected and gone above it. But right now, we've got PCE that's certainly below 6, and then we've got the CPI that has been a little bit more sticky, although we can see clearly that these have come off their peak. They're just not moving down as fast as folks would certainly want. Here's our ISM, Institute for Supply Management, our PMI index. So, we had a bit of an uptick. You can see that on the right-hand side. That's good, but it's still in contractionary territory. And so I think my gut tells me that we're going to meander about below this dotted line. So we're going to continue to be in contraction territory, but we're not going to be, witnessing a tremendous amount of erosion. Again, there's a lot of capital that is flowing around. Credit is still flowing. Banks are still lending to some degree. And I don't think anybody's necessarily motivated to expand capacity right now. So not as much being done on CapEx and capital spending now, but I just think that this number here, the ISM Manufacturing Purchasing Managers Index, is going to remain kind of sluggish for a while. Here's the Conference Board Consumer Confidence Index. You can see expectations continuing to move down. Present situation kind of holding in there a little bit. Here's consumer credit cards, 90 days plus of delinquency. And look at this age cohort. The Gen X, Gen Z, and the millennials are spiking. And you've got a lot more capital discipline on the part of the baby boomers here, which is the retiring generation that is being replaced by these other younger generations. So this is also something that we're going to have to monitor. Credit quality at the lower age cohorts, where people are witnessing a lot of job mobility right now. Here's a quick check-in on job postings. And so, job openings are still positive. They're growing. You can see here, this is a percent change since February of 2020, which is kind of a look before the pandemic really kicked in. And so, we still have 25 to 30%, job openings, but it's rolling over. It's clearly slowing down as there are fewer hiring intentions out there. Here's a look at China. We've got a couple of China slides here, and this is so, as they've reopened, a lot of issues with China right now. A lot of people don't like China. Whether it's the meteorological balloons that are actually spy balloons, whatever the case is, a lot of animosity towards China right now. But you have to respect the fact that they are reopening after this major extended lockdown. You can see both their manufacturing and non-manufacturing PMI indexes moving above 50, which means that they're expanding at the same time that the same readings in the U.S. are showing contraction. Here, as we look at Chinese savings, we see this really spike during the pandemic and all of this extended lockdown, with China being locked down a lot longer than we ever were here in the U.S. But you can see, household savings deposit as a percent of GDP moving higher, and that rate of change really kind of accelerating. Well, this gives China a lot of firepower. Now, China's long depended on exports for its growth, and they've even tempered their own expectations. And even the World Bank, IMF, and all these different folks have kind of like tempered their estimates for China. I think they're beginning to thaw now as people realize, wait a minute, these consumers have a lot of firepower. And once the economy opens, not only can real estate benefit, we're already seeing some signs that the Chinese real estate market kind of settle out a little bit, but there's also a lot of room for consumption as well. And something else I thought was really cool in the last couple slides here was the average number of months to build a single family home has really increased over time. This data series goes back to 1971. You can see like a contractor built, home used to take about 4 months, and now it takes about 9.5 months. You can really see how productivity has evolved over time in the home building industry. And we'll end on this chart, and this shows where basically energy sales from Russia have been going over the last year, dating back to the beginning of the Ukrainian invasion. You see that China has clearly been the savior for Russia. Oddly enough, Germany is up there, but we know that that's going down considerably. And then you've got Turkey and India, which have kind of stepped in to help fill the void from a lot of the European countries. And this chart will look dramatically different from this, even 6 months from now. But it's interesting, all of the embargoes and restrictions put on Russian energy, that they're still managing to get a lot of energy sales done around the world. Well, that's all we have for this week. Hope you've enjoyed the chart pack. Hope you have a wonderful week, and we'll talk to you again soon.